Hi, I'm John Mark Young with Whitaker-Myers Wealth Managers, and welcome back to our Question of the Week video series. This week's question comes from Ben in Orlando, Florida. And Ben asks, what is the most common mistake you see from clients when they're saving for their child's college? Well, Ben, that's a great question. One that really we could probably find a lot of mistakes that people make over their time. An easy one is not saving early enough. Once that baby comes out of the womb and gets a Social Security number, just a small amount of savings could add up to a significant amount of dollars by the time they're 18. They have, using the rule of 72, which is if I get a 10% return, my money doubles about every 7.2 years. They've got two doubles and almost a third, maybe a third by their last year of college. Point is, that's an easy one, but that's not what we're going to talk about today. I'm going to talk about a common mistake that actually could create thousands of dollars in potential tax savings if done correctly. And so what we're talking about today is we're talking about the 529 plan. Now, this is not your common, you should save in a 529 plan. Of course, we know that's a smart move. Actually, what today's video is about is you should not save in a 529 plan because that is costing you thousands of dollars in tax savings. Now, we are not against the 529 plan. As a matter of fact, I love the 529 plan. I have a 529 plan for my children. But is it an either or should it be an and conversation? And I think that's the true answer to the question I'm trying to answer today, which is a 529 should be an and equation. It should not be an or equation. So when you're saving in a 529, we know that it offers tax-free growth, and that's beautiful, but also tax-free withdrawals for qualified educational expenses. Certain states even give you a tax credit for putting money in on the state side, not the federal side. You never get any benefit there on the federal side, but potentially on the state side. But here's the catch. If you use your 529 to pay for all of your college expenses, you could miss out on claiming another valuable benefit. And that valuable benefit is the American Opportunities Tax Credit, or the AOTC, as we like to call it for short. Now, let's first quickly cover the AOTC, the American Opportunities Tax Credit. This is a tax credit that allows you to claim up to $2,500 per student per year for qualified educational expenses during the first 4 years of college. So you can't use this for graduate school. If you're in graduate school, there's another tax credit you can use, but not the AOTC, which is a better benefit. And the way that the AOTC works is the first $2,000 is a tax credit dollar for dollar, but it's a $2,500 total tax credit. So how do I get the next 500? Well, that is coming to you via 25% of the next $2,000 of expenses. So essentially what's happening is you can get a total of $4,000 worth of college expenses that gets you up to a $2,500 tax credit. And the best part, $1,000 of that tax credit is refundable, meaning you could get money back even if you don't owe taxes. It's the same benefit you get for the child tax credit. Part of the child tax credit is refundable, meaning if I don't even pay taxes, I get money back for that. And that is a beautiful thing. Now, here's where many families run into trouble. If you use your 529 plan to pay for the same expenses that you're going to try to claim under the AOTC, the IRS does not let you double dip. You can't claim both benefits for the exact same expense. Therefore, if you use your 529 to cover all tuition and fees, you could completely lose the chance to claim the AOTC. So here's the smarter move and the premise for our video. To maximize your benefits, cover the first $4,000 of qualified college expenses using another funding source. Now, what could these funding sources be? Well, I'm a big advocate of the UTMA account. The UTMA account is the Uniform Transfers of Minors account. And in this account, you can put money away for your child and still receive up to $1,300 of tax-free growth each and every year. And the next $1,300 is taxed to the child's tax rate, which is probably going to be only 10%. So that's $130 of tax for each $2,300 of growth. And more than likely, as you're starting the account, that you're not going to reach that $1,300 of growth. So I can get tax-free growth and have access to the money for other purposes, including college. And those dollars, the UTMA, do not count against the AOTC tax credit like the 529 does. Meaning I could pay that first $4,000 with savings if I wanted to from the UTMA and still claim the AOTC. I can double dip with the UTMA. I cannot double dip with the 529. The other ways you could find another funding source for college expenses, of course, are your cash flow. Hopefully, your cash flow has improved over the 18 years that you've raised your child. You've gotten promoted, you've gotten raises, and that allows a little more money to dedicate towards this additional expense of college, or at least the part of college that you're going to pay for out of your own cash flow, the other part coming from your 529 savings. And of course, you could use other savings that you have accumulated, whether it's Roth distributions. You can take your Roth principal out without a penalty. I could take out of my savings account if my emergency fund is overfunded, or if I have non-retirement savings, bridge accounts, as Dave Ramsey calls them, I could take money out of that. And those could be other funding sources beyond just the 529 for college. Now, why did I say you should take $4,000 out of your UTMA, your out-of-pocket cash flow, or even your taxable savings, and just stop there, use the rest for your 529? Because that's the maximum amount needed to qualify for the AOTC tax credit. So as we've talked about, $4,000 based on the way they calculate that is what you would want to come from some source other than a 529, UTMA, out-of-pocket cash flow, other taxable savings. After you hit that mark, then you can use your 529 plans to cover any remaining eligible expenses that you might have. So let's break it down on a simple example. Let's say you have $10,000 of college expenses for the entire year. How we would potentially advise a client is to pay the $4,000 of that $10,000 in cash or from a UTMA, and this unlocks the $2,500 AOTC tax credit for you. The remaining $6,000, you can cover that using your 529. In this strategy, you're maximizing both tax advantages and not leaving money on the table that the government is giving you. Now, it should be noted that the AOTC does have income limitations, so you need to check with your financial advisor to make sure that your income still qualifies for the AOTC tax credit, or potentially maybe these would be years while your child's in college, you should make pre-tax contributions to your 401k and your IRA to unlock the AOTC tax credit if you're close to the phase-out limits. Again, talk to your financial advisor. That number changes every year, so you want to make sure that you have an up-to-date number. But college is expensive. So why would you leave money on the table? Why would you not get the best advice for that money? And by coordinating how you pay your expenses, you can take full advantage of both the AOTC and your 529 plan. Now, do you need help crafting the best strategy for your family? Well, reach out to us at Whitaker-Myers Wealth Managers, because our advisors are educated on the AOTC, the UTMA, the taxable savings, and the 529, and they're here to help maximize your savings and minimize your tax burden while you take your child through college, which is a very stressful time in your life because of the increased expenses, the child's out of your home, and all those sort of things. We want to try to minimize those as much as possible. And of course, if this video was helpful to you, would you do us a favor? You can like and subscribe, as well as share the video if you found it helpful. Those sort of things help us push our content out to more people and help with YouTube and Rumble's algorithm kicking this out to additional folks. As well as if you'd like to meet with any of those financial advisors, you can go to the comment section of this video where there'll be a link in the comment to click and schedule a meeting with any of those advisors. Thanks so much for watching this week's video. Thanks so much, Ben, for asking that question. We'll look forward to seeing you next week.